On August 4th, 2026, U.S. equity benchmarks surged, but the real story was a stark decoupling. We are seeing a market that has officially abandoned the rising tide narrative for artificial intelligence, shifting instead to a regime of extreme selectivity. This is a high-dispersion environment where granular execution is everything, and the gap between outperformers and laggards is rapidly widening. Midday trading saw semiconductor pioneers Nvidia and Intel leading the advance. This recovery follows a period of heightened volatility, representing a major Bayesian update for market participants. Institutional buyers are utilizing recent pullbacks to reweight toward high-conviction silicon providers, signaling that the probability of a sustained AI capital expenditure cycle remains incredibly high, even as adoption speeds vary across the software stack. But look beneath the surface. While the tech-heavy Nasdaq advanced, the small-cap Russell 2000 lagged significantly. This divergence points to an information asymmetry problem. Large-cap balance sheets offer a perceived safety net against restrictive monetary policy, whereas small caps remain highly sensitive to the cost of capital and lack direct access to hyperscale AI budgets. For hybrid allocators like us at Strata, this dispersion requires a highly disciplined playbook. First, we are treating the price action of Nvidia and Intel as leading indicators for the durability of this late summer recovery. Second, we are monitoring the spread between the Nasdaq and the Russell 2000. We need to see this gap narrow to confirm a healthy, broad-based market expansion, rather than a concentrated, fragile rally. Most importantly, we must evaluate AI software holdings strictly through the lens of actual revenue conversion. We must avoid the temptation of pure momentum. If a company cannot show concrete fundamental support heading into the third quarter of 2026, its valuation is highly vulnerable. In this high-dispersion regime, high-conviction large-cap tech exposure serves as a defensive growth play against macroeconomic volatility. In a market defined by dispersion, the winners aren't those riding the wave, but those building the shore. Keep your focus on execution and watch the margins. This episode is for informational purposes only and is not investment advice. Past performance does not indicate future results. Full disclosures are available at venture-science.com.